All right, so here we are again. Talking with Owen Lee, who is the vice chair of the MBA and also CEO of Success Mortgage Partners. And Owen, you just got back from the meeting, and what we're going to do here for the next like 5 minutes is we're going to give you an update and predictions of what's coming up in the market, and we're going to give you some slides. There'll be a link somewhere on this page. You can just click that link, and you can download the slides so that you can share this with your referral partners, or if you're a branch manager or company owner, you'll be able to share these for your loan officers. Very impressive numbers we got here, Owen. So take it away.
Yeah, it is. It is. And there's a lot of white space on the slide. So be sure to slap your name, your contact information, your photo on those slides so you get promoted when you're sending them to your realtors. Because I really think this is data rich and it's a good story to tell, and you ought to share it with all your referral sources and position yourself as an expert,
All
as
right.
we
So
know you are.
what are we looking at here on the first chart?
So on the first chart, so these slides came from the Mortgage Bankers Association and their economic forecasting team. We're fresh out of Denver off the MBA's annual convention as we're recording this. So this is their prediction for the Federal Reserve and their setting of the interest rates. So as we can see, this is about a 10-year chart, and it just gives good perspective about how high we had to go to get inflation to act more tamely. And so if you look at that high water mark where we were, and then we have the 50 basis point cut in the books from the September 2024 meeting, and we're predicting six more cuts. So six more 25 basis point cuts until we get down to a stopping rate, or what economists like to call the terminal rate, at 3.5%. And so that's really good because, as we all know, right, and we get those calls from consumers, and we have to have our 90-second elevator pitch on how the Federal Reserve doesn't control the home mortgage interest rates. But momentum is important in an economy. And when the Fed is on the sidelines lowering rates, that provides momentum to the team on the field. So it's much more likely to get a stable or declining home mortgage interest rate if the Fed is in a cutting cycle than it is if they're in a holding cycle, or, God forbid, in a rising cycle, as we've been through for the past 2.5 years. So
So
really good news.
this is very good news. And I know here in a couple slides, you're going to be showing what does that mean in loan origination. Before we get to
Mhm.
that slide, talk to us a little bit about this one.
So this is their prediction on four different interest rate gauges. Of course, the most important to us is the 30-year fixed rate mortgage. That's the line that is in red. So as you can see, the red color is where we're at with the home mortgage interest rate, and then the 10-year and the 2-year treasury yield, and then the blue line is the Fed funds rate. But let's just focus in on that red line for a second. And this, I'm kind of geeky when I get into the data and get into the numbers, and this kind of excites me. I mean, they really see the home mortgage interest rate market riding at about 6%. And, they show it as a little bit lower than 6%. Maybe we go down to 5.875. But if we're riding, two things I'm excited about. Number one is we can have a really healthy market at 6%, a very healthy market. I know people got into the twos and the threes, and that was fun while it lasted. But that's not normal, and it's not sustainable. That only happens if the Federal Reserve is buying 80 to 90% of all new mortgages in the United States, which is not fiscally sustainable. So being at 6 in a regular market where the Fed's not buying any mortgages is great for interest rates. And so is stability, right? And of course, we're not going to stay exactly stable. But hopefully not the herky jerkiness that we've seen where, we bounce around so much that we can't get what I would call a regular good market started. So this is a really good prediction, and riding around 6%. Carl, I know you and I are kind of long timers in this industry. We've both had periods where stability and 6%, I'll take that all day long. There'll be a lot of buyers at that rate.
I made my first million as a W-2 income in the mortgage business as an originator, originating my own loans. I made my first million when rates were in the mid sevens. And so
Yeah.
this is very good news. This is very good. And that was back probably 2004, somewhere in that neighborhood. So I guess what this
Yep.
really means then, like going forward, is some good news on mortgage origination numbers. Talk to us a little bit about
Yeah.
that.
So if you look at the mortgage origination number, right, this chart tracks overall mortgage origination dollar volume, which is the light blue bar graph. And then the blue line is purchases and the red line is refi volume. So if you look at that, obviously we had the high water mark years recently at 2020 and 2021, where we were over $4 trillion as a total dollar volume lent on first mortgages. This bar graph, you can see we fell to a multi-year low at 1.4 in 2023. We're riding just below 1.8 trillion in 2024. So they're predicting with that 6% interest rate to get to 2.3. And if you look at that 2.3 in 2025, a little above 2.4 in 2026, 2027 even higher. I'm really not sure you can predict an economy 3 years out, but those 2025 and 2026 numbers look pretty gosh darn good. That's a 25 to 30% increase over where we are right now, and a 40 to 45% increase off the low of 1.45. Again, very healthy for those of us. And then just give me 1 second here and concentrate on the blue line, that kind of royal blue line that cuts through the graph. That's the percentage of purchases. So if you just focus on that line, 2025, 2026, 2027, right? And then we don't know about 27, but certainly 25 and 26. Those are like the third and fourth best purchase years in the last 20 years. So if somebody told you you were going to have, even if you call it the fourth and fifth best years out of the last 20, right? The last generation, that is very opportunistic for those of us that are in the industry every day, that get our elbows dirty every day, that do our prospecting every day. We have got an opportunity to succeed. And after what we've been through for the past 30, 36 months, that is just really welcome news. So I think this is a very healthy, good forecast. We also have a decent refinance opportunity. I think there's going to be some cash out opportunities. You know, consumer debt is high, home equity is high. That's a great recipe for cash outs, but looking really good, especially for the next 24 months.
And then I guess kind of summarize it all up. What are we looking at here?
So this is a fun chart if you just expand your mind a little bit, right? The NBA started doing this 2 years ago. People really like it. So they have a blue line, right? And the blue line is their forecast. And then they have a green line, which is what they assume if interest rates are 100 basis points better or 1 full point better. So instead of a 6% market, a 5% market. And then the orange line is if rates are 100 basis points or a full percentage point worse in rate. And I like this chart. I think it's kind of fun. Granted, I'm a little bit nerdy when it comes to things like this, but just go down to that total origination scenario, that one along the bottom axis. And the thing that kind of warms my heart about this is, even if you look at that orange line, right, which is if rates are 100 basis points worse or if rates stay at 7, they're still predicting a 10 to 15% increase over the next 24 months. So worst case scenario, rates 100 basis points higher, we're at 7 instead of 6. They think we're going to go up 15%. And then, of course, if you really want to have fun, you know, you can do some math on the green lines, and that shows us being up 40% over this year. I'm not 100% certain that that's going to happen. But even the blue and the orange lines, right? You look at the access, look at that purchase origination scenario going up still another 10 to 15% over the next 2 years. even if rates are 100 basis points higher than what they're predicting. So just a lot of good information packed into one graph.
Great stuff. And Owen, everybody has your permission to totally swipe these slides,
100%. Yep.
put their name, their phone number, their contact information on it, and
Put your
distribute it
info
off.
on there and
Yeah,
use it to promote yourself. Use it to promote yourself with realtors. You know, the data in here for realtors is very purchase rich, right? Or I'm very purchase rich, very valuable. Put your name on it. And I know when you talk about doing joint marketing and flyers and whatever, they always look at the loan officers that bring value, and this kind of data brings some value.
very good. Hey, so when you're ready to capitalize on some of this increased growth, maybe some of the increased growth, frankly, that you deserve, and you've been paying your dues here for the last couple of years, like the rest of us have, and you're ready to like cash in on this, there's a link somewhere on here. Go ahead and click on that, and we can talk about some of the different strategies that we're using, and we can also talk about some of us are sharing team members, like assistants. We're sharing assistants so that you don't get the burnout. And while they're chasing the conditions and chasing the pay stubs, we can focus our time on moving ourselves up to that green line
That's
ourselves,
right.
no matter what the market does. And we could talk to you about that too. So,
Well, Carl, I think you have an important point, right? When you have opportunity out on the field, you got to make sure that old, axiom about why you doing $20 an hour work when there's $100 an hour work available. I mean, these pieces of information clearly show that $100 work is available for people who are willing to do it. So I think that's a very excellent point to make while we're looking at this data.
especially when you don't have to train the assistants, that they're already trained, they're ready to go, they're up and going, and
That's right.
they've already closed hundreds of loans even before they start working on their first one. So anyway, click on the link and we can talk to you more about that. Hey, thanks, Owen. We appreciate you, and we'll see the rest of you right back here next week. Thanks again, Owen.
Thanks, everybody.